In September of 1929, the American economy was not just booming, it was invincible. The concept of a recession had been psychologically abolished. The leading economist of the era, Irving Fisher, famously declared that stock prices had reached what looks like a permanently high plateau. He wasn't a fool, he was a genius, looking at data that made no sense by historical standards, but made perfect sense if you believed in a new era. The country had just been transformed by revolutionary technologies, the radio, the automobile, and the electric grid, that promised to unlock infinite productivity. A share of the Radio Corporation of America, RCA, had surged from $1 to $114 in a few years. It was the NVIDIA of its day, a company that was physically changing the world, justifies any valuation, no matter how absurd. Fast forward to 2026, and the script is repeating with terrifying precision. We are currently living through a period that future historians will likely call the second roaring 20s. We have our own revolutionary technology and artificial intelligence. We have our own toward new era narrative that claims productivity gains will make old valuation metrics irrelevant. And just like in 1929, we have a retail investing mania that has turned the stock market into a national casino. In the 1920s, it was shoeshine boys giving stock tips. Today, it is Reddit forums in 0DTE. 0 days to expiration options traders. The mechanism of speculation has changed, from margin loans at the brokerage window to leveraged derivatives on an app, but the psychology is identical. It is the belief that trees can grow to the sky because the Federal Reserve creates the sunlight. However, the 1929 playbook is not about the crash itself. Everyone knows about Black Tuesday. The part of the playbook that matters right now, the part that constitutes a 90-day warning, is what happens in the final euphoric weeks before the collapse. It is a phenomenon known as the melt-up. History shows that the biggest gains in a bubble often come at the very end. In the summer of 1929, the market shot up nearly 30% in 3 months. It was a vertical ascent. This final rally is designed to suck in the last skeptics. It forces the bears to capitulate. When the last pessimist finally buys in, there is no one left to buy. The market effectively runs out of fuel. We are seeing this dynamic today. The market is becoming dangerously concentrated. In 1929, the rally was driven by a handful of trusts and utility holding companies. Today, the S&P 500 is effectively just 5 or 6 massive tech conglomerates, masking the weakness of the other 495 companies. If you strip away the AI giants, the average American company is actually struggling with high interest rates and falling demand. The index is lying to you, just as it lied in 1929. But the most critical signal, the one that starts the 90-day countdown, is not in the stock market, it is in the bond market. It is the behavior of the yield curve. For those who don't watch the bond market, the yield curve is simply the difference between short-term interest rates, like the 3-month Treasury bill, and long-term rates, like the 10-year Treasury bond. Normally the curve is upward sloping. You get paid more interest for locking your money away for 10 years than for 3 months. But before every recession in modern history, the curve inverts. Short-term rates go higher than long-term rates. This happened in 1929, 2000, 2008, and it happened again in this cycle. The inversion is the warning light. But, and this is the part everyone gets wrong, the crash does not happen when the curve inverts. The crash happens when the curve uninverts. Why? Because the curve uninverts when the Federal Reserve suddenly realizes they have broken something. When the economy starts to crack, the Fed panics. They aggressively cut short-term interest rates to try and save the system. This causes the short end of the curve to collapse, restoring the normal slope. In 1929, the yield curve uninverted just weeks before the crash. In 2008, the yield curve uninverted just before Lehman Brothers failed. The uninversion is the signal that the soft landing is a myth and the hard landing has arrived. Right now in 2026, we are watching the yield curve steepen back towards positive territory. The Federal Reserve is cutting rates, telling us that they have defeated inflation and secured a Goldilocks economy. But history screams that they are cutting because they see the liquidity drying up in the plumbing of the financial system. They are cutting because the patient is going into cardiac arrest, not because the patient is healthy. The danger of this moment is amplified by leverage. In 1929, investors bought stocks on 90% margin. They put down $10 to buy $100 worth of stock. This meant that a 10% drop in the market wiped out 100% of their equity. Today we have shadow leverage. Hedge funds are leveraged 10 to 1 using treasury basis trades. Retail traders are leveraged 100 to 1 using options. The system is tighter and more fragile than it appears. When the selling starts, it triggers a liquidity cascade. As prices fall, margin calls go out. To meet the margin call, investors have to sell their best assets. They don't sell what they want to sell, they sell what they can sell. This is why in a crash, everything falls together. Gold falls, bonds fall, stocks fall, correlations go to 1. In October 1929, the market didn't just go down, it evaporated. There were moments on the floor of the NYSE where there were simply no bids. You held a share of stock that was worth $100 yesterday, and today you couldn't sell it for $1. The psychology of this stunning 90-day warning is specific. It is the transition from greed to complacency to fear. We are currently in the transition from greed to complacency. The VIX, the fear index, is historically low. Investors are selling insurance against a crash because they believe a crash is impossible. They are picking up pennies in front of a steamroller. In 1929, the newspapers in September were full of articles explaining why the good times would last forever. Industrial production is robust. The consumer is strong. They were looking in the rearview mirror. The stock market is a forward-looking mechanism, but in a bubble it becomes a mirror of its own vanity. It rises because it rises, and when the music stops, usually triggered by an obscure event in the corner of the market nobody is watching, like a bank failure in Austria 1931, or a subprime mortgage default 2007, the exit door is the size of a pinhead, and everyone tries to run through it at once. The 1929 playbook tells us that the initial drop is often seen as a buying opportunity. In late October 1929, after the first big crack, the Rockefellers and the Morgans famously walked onto the floor of the exchange and bought massive blocks of stock to prop up the market. It worked for a day. Then the selling wave returned harder and faster. The buy-billers were annihilated. This is the final trap of the cycle. The conditioning of the last decade has taught every investor that buying the dip is a guaranteed path to wealth. But in a deleveraging event, the dip keeps dipping. The parallels are not exact. History doesn't repeat, but it rhymes. Yet the rhyme scheme is undeniable. An overextended tech sector, a Fed that believes it has mastered the business cycle, a retail public all in on the market, and a yield curve that is screaming recession while the politicians scream recovery. The clock started ticking the moment the Fed hinted at the first rate cut. That was the bell. We are now in the final round. If the stock market melt-up is the fireworks display that keeps the crowd looking up, the real danger is the fuse burning quietly along the ground. In 1929, that fuse was margin debt, money borrowed to buy stocks. In 2026, the fuse is commercial real estate, CRE, and the shadow banking swamp known as private credit. This is where the mathematical inevitability of the crash resides, hidden behind opaque accounting and regulatory forbearance that is about to run out of time. To understand the magnitude of the problem, you have to look at the maturity wall. Commercial real estate loans are not like your 30-year home mortgage. They are typically short-term, interest-only loans that balloon after 5 years. The borrower pays the interest, and at the end of the term they have to pay back the entire principal, usually by refinancing into a new loan. In 2026, roughly $1.8 trillion to $2 trillion of these commercial loans are coming due. This is the wall. These loans were originated in the zero-interest rate era of 2021. The office buildings were full, and the interest rate was 3%. Today, the office buildings are 20 to 30% empty due to the permanent shift to remote work, and the interest rate to refinance is 7% or 8%. The math is catastrophic. The building is generating less income, but the mortgage payment is doubling. According to data from the National Bureau of Economic Research, nearly 44% of all office loans currently exceed the value of the property. The owners are underwater. In a rational market, these borrowers would just hand the keys back to the bank and walk away. This is already happening with major landlords like Brookfield and Blackstone, defaulting on trophy towers in Los Angeles and New York. But the real crisis isn't the landlord, it's the lender. This brings us to the regional bank trap. In 1929, there were thousands of tiny rural banks that had bet the farm, literally, on agricultural land prices. When crop prices fell, those banks failed, triggering the Great Depression. In 2026, the agricultural land is the suburban office park and the downtown skyscraper. The too big to fail banks, JP Morgan, Bank of America, are smart. They saw this coming and reduced their exposure. But the regional banks, the ones with $10 billion to $100 billion in assets, went all in. Regulatory data shows that small and mid-sized banks hold nearly 70% of all commercial real estate loans in the United States. For many of these banks, CRE loans make up 40% or 50% of their total loan book. If those loans default, the bank is insolvent. We saw a preview of this in 2023 with Silicon Valley Bank and Signature Bank, but those were idiosyncratic failures caused by bad interest rate bets. The coming wave is a credit failure. It is a realization that the collateral backing the loans is worthless. The government saved the banks in 2023 with the Bank Term Funding Program, BTFP, which allowed them to pledge their underwater bonds at par, but you cannot pledge an empty office building at par. The Federal Reserve cannot print tenants. However, the banking system has a new, darker partner in crime, private credit. This is the modern incarnation of the shadow banks of the 1920s. Private credit firms are non-bank lenders. They take money from pension funds and insurance companies and lend it directly to risky companies that traditional banks won't touch. This industry has exploded from $400 billion in 2010 to over $2 trillion today. It is operated almost entirely in a Goldilocks environment of low rates and no defaults. But private credit has a fatal flaw: mark-to-myth accounting. Unlike a bank or a public bond fund, private credit assets do not trade on a public exchange. There is no daily price ticker. The value of the loan is determined by the manager of the fund itself. This creates a perverse incentive. If a borrower gets into trouble, the private credit manager doesn't want to mark down the loan because that would hurt their performance numbers and scare away investors. So they engage in extend and pretend. They lend the struggling company more money just to pay the interest on the old money. They call this payment in kind, PIK. It's a Ponzi scheme wrapped in a suit. It makes the fund look healthy on paper. Look, we have a 12% return and 0 defaults, while the underlying borrower is rotting from the inside out. The 90-day warning will likely trigger when this volatility laundering breaks. It won't start with a stock market crash. It will start with a gating event. A major private credit fund or a non-traded real estate investment trust, REIT, will announce that it is suspending redemptions. Investors, realizing the stable 10% returns were an illusion, will try to pull their money out. The manager will say, "Sorry, we can't sell the assets fast enough. The gates are closed." This happened to Blackstone's Bright in late 2022, but they managed to stabilize it. In 2026, with the maturity wall hitting, there will be no stabilization. When the gates close, the panic spreads to the pension funds and insurance companies that allocated billions to these safe alternatives. They will suddenly realize they are holding illiquid assets that are worth 60 cents on the dollar, not 100. To raise cash, they will have to sell what they can sell: liquid stocks and bonds. This is the mechanism of contagion. The rot in the private market forces a fire sale in the public market. The melt-up we discussed in Section 1 is partially driven by this dynamic. As the smart money exits real estate and private credit, that capital has to go somewhere. It flows into the magnificent tech stocks, pushing them even higher. It creates a barbell economy. The top is hyperinflated AI stocks, while the bottom is disintegrating real estate in small business. This divergence cannot last forever. In 1929, the divergence snapped when the banks started calling in margin loans. In 2026, it snaps when the regional banks are forced to recognize the losses on their real estate portfolios. Regulators have allowed them to delay this recognition, hoping that interest rates would fall fast enough to save the borrowers. But as we saw with the yield curve uninverting, the cuts are coming too late. The tenants have already left. The keys are already being mailed back. The most terrifying chart for the regional banks is the vacancy versus debt service ratio. In cities like San Francisco, Chicago, and New York, office vacancy is stuck above 20%, but the expenses of running those buildings, insurance, taxes, maintenance, have skyrocketed due to inflation. This creates a negative equity spiral. The building is worth less than the land it sits on. When the bank takes possession of the building, they don't get an asset, they get a liability. They have to pay the property taxes and the security guards for an empty shell. This burns through the bank's capital reserves at lightning speed. Watch the KBW Regional Banking Index, KRE. If you see it start to diverge from the S&P 500, if tech stocks are hitting all-time highs, while regional banks are hitting 52-week lows, that is the final confirmation. That is the market telling you that the plumbing has burst, even if the party upstairs is still raging. The 1929 playbook is a story of leverage moving from the visible to the invisible. Then it was stock margin, now it is shadow banking leverage. The system is far more interconnected than it was a century ago. A default in a private credit fund in New York can trigger a margin call for a pension fund in Tokyo. The 90-day warning is effectively a countdown to the moment when the mark-to-myth meets the mark-to-market, when the illusion of stability is shattered by the reality of price. It just like in 1929, the authorities will tell you the banking system is sound and resilient. Right until the Friday afternoon they seize the banks. The terrifying reality of the 1929 playbook is not that the stock market crashes. A market crash is painful, but it is recoverable. The true horror of the 1929 scenario is what happens after the crash, when the government attempts to fix it. In the 1930s, the Federal Reserve made a historic error. They allowed the money supply to collapse by nearly 30%. They let the banks fail, they let the credit contraction run its course, and they forced the economy into a deflationary depression that lasted a decade. The central bankers of 2026 have studied this history. They have written PhD theses on it. Ben Bernanke, Janet Yellen, and Jerome Powell have all sworn a silent oath to the ghost of Milton Friedman that they will never allow deflation to happen again. And this is precisely why the outcome of the 2026 crisis will not be a Great Depression, but a great inflation. When the maturity wall hits and the regional banks begin to dissolve, the Federal Reserve will face a binary choice. Choice A, allow a deflationary collapse that wipes out the debt, but also wipes out the U.S. government's ability to pay its own bills, leading to a sovereign default. Choice B, print enough money to monetize the entire debt stack, corporate, real estate, and sovereign, and sacrifice the currency to save the system. There is zero doubt about which path they will choose. They will choose the pivot. It will not be a polite interest rate cut. It will be a fire hose of liquidity that makes the 2020 COVID stimulus look like a rounding error. They will implement yield curve control, YCC, capping long-term interest rates to prevent the government from going bankrupt. They will buy the underwater commercial real estate bonds at par. They will guarantee every bank deposit, regardless of size. This triggers the final and most dangerous phase of the economic cycle, described by the Austrian economist Ludwig von Mises as the crack-up boom, catastrophe house. In a normal boom, people buy stocks because they believe the companies are growing. In a crack-up boom, people buy stocks because they are terrified of holding cash. They realize that the central bank has committed to destroying the currency to save the debt. The psychology shifts instantly. The goal of investing changes from capital appreciation to capital preservation. You buy the S&P 500 not because you love Apple's earnings, but because Apple is a real asset and the dollar is a melting ice cube. The chart of the German stock market during the Weimar Republic is the roadmap for this phase. In 1923, the German stock market rose by millions of percent. If you looked at your portfolio in paper marks, you were a billionaire. You were rich beyond your wildest dreams. But in real terms, priced in gold or bread or energy, the stock market actually fell. The currency was collapsing faster than the stocks were rising. This is the trap of the crack-up boom. It creates an illusion of wealth. This environment destroys the middle class who hold their wealth in cash and fixed-income pensions. It enriches the asset holders, the ultra-wealthy who own land, gold, and equities. This leads inevitably to the fourth turning, proposed by historians William Strauss and Neil Howe. A fourth turning is a period of intense social and political upheaval that occurs roughly every 80 years. 1780s Revolutionary War, 1860s Civil War, 1930s Great Depression, and 2020s the global sovereign debt crisis. During a fourth turning, the institutions that held society together lose their legitimacy. When the public realizes that the money is rigged, that the government is actively stealing their labor through inflation to bail out the banks, the social contract snaps. We will see strikes, civil unrest, and the rise of populist political movements that demand radical solutions. The rule of law becomes fluid, property rights become negotiable. In this environment, the only safety lies in assets that have no counterparty risk. This is why central banks around the world, specifically China, Russia, and Poland, are buying gold at record rates. They are preparing for the end of the fiat dollar system. Gold is the only financial asset that is not someone else's liability. It cannot be printed. It cannot be defaulted on. In a deflationary crash, 1929, cash is king because it buys more stuff. In an inflationary collapse, 2026, cash is trash and gold is the ark. Bitcoin plays a similar but more volatile role. It is the fire alarm of the financial system. It reacts instantly to liquidity injections. In a crack-up boom, Bitcoin is likely to decouple from the stock market and trade like a leveraged version of gold, a digital bearer asset that cannot be diluted by a central bank. However, the government knows this. They know that capital flight into gold and Bitcoin accelerates the collapse of the dollar. Therefore, the 90-day warning is not just about market timing, it is about regulatory timing. As the crisis deepens, the financial Iron Curtain will descend. We may see the return of capital controls preventing you from moving money out of the country. We may see windfall profits taxes on gold and crypto. And in the extreme scenario, we could see a repeat of Executive Order 6102. In 1933, President Roosevelt didn't just devalue the dollar, he criminalized the ownership of gold. He forced citizens to surrender their real wealth in exchange for paper money right before he devalued the paper money. The government cannot tax its way out of this debt. It cannot grow its way out. It must inflate its way out. And to do that effectively, it must trap you in the burning building. The warning signs are flashing red. The yield curve is uninverting. The commercial real estate maturity wall is crumbling. The insiders, CEOs, and billionaires are selling stock at the fastest pace in years. They are building bunkers, buying farmland, and acquiring second passports. They are engaging in personal de-risking while telling the public that the economy is strong. The window act is the complacency phase we are in right now. Once the panic starts, liquidity disappears. You cannot buy fire insurance when the house is already burning. The premiums become infinite. The 1929 playbook is not a prophecy, it is a pattern. The math of leverage and debt always resolves the same way. The only variable is who holds the bag when the music stops. In 1929, the public held the bag. In 2008, the public held the bag. In 2026, the bag is $35 trillion of unpayable sovereign debt, and the public is about to be handed the bill one last time.